Listen, you are paying a silent penalty of 30% on your hard-earned wealth simply because you don't know the rules the elite use to stay rich. Most professionals, and I mean high performers like you, are trapped in a cycle of earning personal income, which is, quite frankly, the most heavily taxed form of wealth on the planet. You are working 40, 50, or 60 hours a week, only to see the government take its cut off the top before you can even think about investing. While you are grinding for a marginal salary increase, the elite are scaling their net worth by playing a completely different game. Now, I am here to tell you that if you want to reach the next level of financial independence, you shouldn't just focus on making more money. You need to focus on tax arbitrage. It is the fundamental difference between working for your capital and having the legal system protect your capital. Think about it. If you earn $100,000 as an individual, you might only keep $70,000, right? But if you structure that same $100,000 through the right vehicles, you can keep nearly all of it to reinvest in your own growth. By the end of this video, I am going to show you how to treat the tax code as a government-subsidized reinvestment plan, one that scales your net worth 30% faster than your peers. I will break down the exact mechanisms that actually turn tax liabilities into investment assets. If you are ready to stop being a passive participant in your own wealth erosion and start building like a true architect, then pay close attention. We are moving beyond the basics and into the strategies that actually move the needle. Look, let's look at the hard data, because the numbers don't lie, even if your paycheck does. If you are earning $200,000 a year as a high-performing W-2 employee or a straightforward 1099 contractor, well, you aren't actually a high-net-worth individual yet. Serious. You are a high-tax target. Between federal income tax, state tax, and that often overlooked self-employment tax, I see professionals losing 30 to 40% of their gross earnings before they can even think about investing. You know? That 30% isn't just a cost of doing business. It is the single greatest destroyer of your long-term compounding potential. To really understand the gravity of this, I apply the rule of 72. This is a simple mental model. You just divide 72 by your expected rate of return to see how many years it takes for your money to double. Now, if I take that $60,000 you just handed over to the government and instead keep it within my own ecosystem, earning a standard 8 to 10% return, that capital would have doubled every 7 to 9 years. Over a 20-year horizon, that 1 year of lost tax money represents nearly $250,000 in vanished net worth. This is the fundamental divide between income generation and tax arbitrage. Most people focus on the top line, how to make more, but the wealthy, they focus on the bottom line, how to keep and redevelop. I don't want you to just own personal income. I want you to control it.
When you earn a salary, you are the most taxed asset in existence. However, when I shift that income into a strategic corporate structure, I am creating a legal shield around my capital. In this environment, the business earns $1, spends what it needs to grow, and I am only taxed on what's left. Look, you are currently paying taxes on what you earn, then trying to build a life on the leftovers. I am building a life and a business first, then letting the government have a seat at the table only after the growth is secured. But simply having a business name on a piece of paper isn't enough, right? There is a specific structural hierarchy that dictates whether your entity is a legitimate shield or just a paperweight. However, there is one specific mistake I see almost every entrepreneur make when they first set up these structures. And honestly, it's the exact reason the IRS flags 1099 earners more often than major corporations. Look, the single biggest mistake you're making right now is staying a sole proprietor for way too long. If you actually want to scale, really grow, I need you to move into what I call the 3-step scaling playbook. Step 1 is entity optimization. See, most entrepreneurs start as a standard LLC, which is fine at first. But as soon as your net profit crosses that $60,000 to $80,000 mark, you are officially overpaying the government. By electing S-Corp status, I can show you how to split your income into two distinct buckets: a reasonable salary and business distributions. Now, you only pay that 15.3% self-employment tax on your salary. The distributions? Those are exempt. Think about it. If your business clears $150,000 and you set a reasonable salary of $60,000, you've just saved over $13,000 in taxes instantly. That is pure capital you can immediately reinvest back into your growth. Step 2 involves strategic deductions, and I'm talking about things that go way beyond just writing off your laptop. Intrigue. I want you to look at the Augusta Rule, officially known as Section 280A. This allows you to rent your personal residence to your business for up to 14 days a year for meetings or retreats. Your business gets the tax deduction, and you receive that rental income personally 100% tax-free. To take it further, we look at Section 179. If you need a vehicle for your operations that weighs over 6,000 pounds, think a heavy-duty SUV or a truck. You can often deduct the entire purchase price in a single year through accelerated depreciation. You're turning a necessary equipment purchase into a massive tax shield. Finally, Step 3 is tax-advantaged reinvestment. Once you've optimized the structure and maximized the deductions, you're going to have a cash surplus. Instead of letting that sit in some low-yield savings account, you move it into a solo 401k or a SEP IRA. This allows you to contribute up to $69,000 per year, which drops your taxable income by that exact amount. You're essentially paying yourself instead of the IRS, creating a wealth engine that grows at 8 to 12% annually through market compounding.
This 3-step playbook is how you build a fortress around your wealth. But even with the perfect entity and the best deductions, there is a hidden trap in the tax code that can trigger an automatic audit if your lifestyle doesn't match your ledger. In fact, there's one specific transaction that looks like a deduction but acts as a red flag for the IRS. And honestly, almost every lifestyle entrepreneur is doing it right now without even realizing the risk. I want you to take a look at two identical versions of the same professional. Let's call them Investor A and Investor B. Both are high performers earning $250,000 a year. Now, on the surface, they look exactly the same, right? They live in the same neighborhood, drive similar cars, and generate the same value for their clients. But they are playing two entirely different financial games. Investor A follows the standard path. They earn their $250,000, pay an effective tax rate of roughly 35% between federal and state obligations, and invest what's left into a standard brokerage account. Over 10 years, assuming a conservative 8% market return, Investor A builds a very respectable portfolio. However, they are paying a massive ignorance tax every single April, simply because they treat their income as one flat bucket. Investor B, on the other hand, uses the tax arbitrage playbook I've been detailing. By utilizing an S-Corp structure, optimizing the split between a reasonable salary and shareholder distributions, and maximizing a solo 401k with a profit-sharing component, Investor B legally reduces their tax liability by approximately $35,000 every single year. Now, here is where the math becomes, well, life-altering. Investor B doesn't spend that $35,000 on a lifestyle upgrade. No, they reinvest it. When you take that $35,000 annual tax savings and compound it at an 8% return over the same 10-year period, the wealth delta is staggering. After 1 decade, Investor B has accumulated an additional $498,000 in their portfolio. That is nearly $500,000 created out of thin air purely by changing how they interact with the tax code. Investor A worked just as hard, took the same risks, and provided the same value to the marketplace, yet they are $500,000 behind simply because they followed the rules written for people who don't understand how money actually moves. I have to ask you, Are you comfortable letting $500,000 slide through your fingers just because you didn't want to adjust your filing status or hire a more aggressive strategist? You see, most people settle for the standard path because it's simpler. But I mean, is that simplicity really worth a $500,000 penalty? But as massive as this 10-year delta is, there is an even larger variable we haven't touched on yet. While investor B has $500,000 more in their account, they could still lose 20 to 30% of that to the government the moment they try to spend it. Unless, of course, they use the one specific exit strategy that turns this entire balance into tax-free wealth, a strategy that most CPAs are actually afraid to talk about. Look, that exit strategy, it's the final piece of the puzzle. I mean, it is the difference between simply having a large number on a digital screen and actually keeping that wealth in your pocket for generations. You see, I want you to understand one fundamental truth. Tax strategy is not about evasion. It is about efficiency. Evasion is a crime. Efficiency, on the other hand, is a competitive advantage.
Most people treat taxes as an annual chore. An afterthought they just hand off to a CPA once a year. But listen, if you want to scale your net worth 30% faster, you have to treat tax as your largest controllable business expense. By optimizing your legal structure, maximizing your depreciation, and utilizing the same leverage as the top 1%, you are not just saving money. You are reclaiming your most valuable asset, your time. Think about the math one last time. Every dollar you do not send to the government is a dollar that stays in your portfolio, compounding and working for you 24/7. Serious? Over a decade, that 30% difference in efficiency creates a gap so large that no amount of hard work or hustle can ever bridge it. You now have the blueprint to stop paying the silent penalty and start playing the game by the actual rules. The difference between where you are and where you want to be is often just a matter of structure. So, if you are ready to stop being just a high income earner and start being a high net worth strategist, hit subscribe and join us here at Wealth Architects. I have also put together a comprehensive wealth scaling checklist to help you audit your own strategy. You can find that linked in the description below. I will see you in the next video.